Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out there in the chat by my good friend Cameron May, also a great educator, 20-plus year veteran of the financial markets, and he is there to answer your questions. Welcome to all of you for being here, whether you're here on the recorded version or the live version. We're grateful that you are here. We're grateful that you are watching. And we're going to talk a little bit about index options. We're going to talk about our 14-7 strategy that we've been discussing. And it's been an interesting week since the last time we were together, for sure. And a lot of movement in the index markets. We'll take a look at that, and we'll jump into perhaps another couple of strategies. And we'll talk about, again, some of the characteristics of index options relative to regular equity options. So as we do that, we're going to get into some of the topics here, but we need to take care of a couple of housekeeping items. First of all, first and foremost, remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. Remember that equity and the index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and transaction costs. Remember also that spread trading, including some of the strategies we're going to be doing today, must be done in a margin account. So be aware of that. We're going to be talking about technical analysis and probability analysis, and to a large degree kind of taking a cue from fundamental analysis. All of those are theoretical in nature. None of those are guarantees as to what the market is going to do. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the thinkorswim desktop software platform. It is a great learning environment. We're going to be using the paper money side of it. That's a great sandbox to learn. It doesn't do certain things when we move from paper trading to live trading. Paper trading doesn't allow the use of studies in scans and searches, and it doesn't facilitate the early assignment of short options. That's something we got to pay attention to if it's an American-style short option. There are some indices that are American-style. The vast majority of index options are, however, European-style and do not allow for early exercise and assignment. So that's one of the benefits, potentially, of trading index options. We'll talk about that as we get into that discussion. Remember that everything we talk about, again, there is the potential for risk, and investing involves risk, including the loss of principal. When we talk about stops and stop loss orders, remember that stops don't guarantee the execution price, just the activation price. And in the event of a stop limit, there is the potential that the price of the index or the underlying or the option could move around or gap around that limit area, and that order would not execute. So be aware of that. We'll talk again about those as we get into these discussions here today. And we're going to just kind of give us a brief agenda. We're going to talk about index options. We're going to discuss some strategies. We're going to look at examples, and we're going to pop over here to the thinkorswim desktop software platform. Now, Jerry asks a great question. How do we tell if it's European or American style? And I'll show you how to do that. We're going to work on kind of a real quick filter that we've talked about before in this context of how we can kind of come up with an understanding of and maybe really a refined list of European style indexes that are optionable that allow us to trade some of those characteristics. So let's take a look really quickly at what's going on in the market. We're going to then go into our 14-7 strategy. And for those of you who are brand new, I'm going to spend a little bit of time talking through this strategy because we're kind of on the cusp here, and I want to look at some additions to the strategy. So we'll talk through it as we get into this discussion. But let's take a look at what's going on. S&P 500, which is the broad market definition, right? This is the kind of broad cross-section of the market. The SPX is the index. We've also looked at XSP, which is the micro version of this index, which is just simply a smaller index. Now, remember, an index in and of itself isn't a tradable instrument. right? We can't buy and sell shares of the index because the index is simply an accounting of value of the components of the index. So the SPX is a cap-weighted accounting of the value of the stocks within the index, the 400 some odd stocks in the S&P 500. So we can't buy and sell shares of the index, but we can trade the options, and that's kind of where we get to this particular webcast. But let's see what we've been doing here. I mean, we've got this RSI that's been ticking lower. We've got the price of the index that yesterday kind of tapped that 200 period simple moving average. And now we get a little bit of a move today. Let's kind of zoom back in here. So we saw this kind of gap down sell-off yesterday, tapped the 200, started to come back. So you think about in terms of what that means, the 200 period simple moving average. And I'll tell you what, if you want to learn more about these moving averages and how they're used and how they're constructed, Cameron May has a great series on Fridays, Advanced Charting Techniques, where he breaks down a lot of different indicators, including some of these moving averages. I'll let him put the link to that series out in the chat there. But the 200 period moving average is commonly used. Not every institutional trading organization uses a 200 period moving average, but many do. I don't know if most do because I don't know most institutions, but I can clearly say many institutional traders use the 200 period moving average as a definition of long-term trend. And one of the reasons maybe why we saw a little bit of a bounce up off of there is that price-wise, the SPX tagged that 200 period simple moving average yesterday, which is very likely an algorithmic trigger for institutional trading systems. The price gets to that 200, that may trigger, as long as it doesn't go through, which it didn't, triggers buying orders to step in at that 200 period moving average, assuming potentially a bounce, and thus potentially creating a bounce up off of that 200 period moving average. Now, we saw a little bit of a push to the upside. We didn't see a lot of follow through today. What we saw was a little bit of a gap up and then a moving down in that 200 period moving average, but we're off of the 200 period moving average, which would suggest that maybe there's a little bit more buying here. Not seeing a lot of push, but this has been kind of toggling. This candle has kind of been toggling red and green since the open a little over an hour ago. It, at the moment, is red, which would suggest that there's a little bit of downward movement. It's down 0.1%. And so it's kind of giving us that sense that maybe there is some equilibrium at the moment. This isn't really a momentum candle, one direction or the other, neither to the downside nor to the upside. It has the potential to be a bounce candle, but it's not that yet. Just out of curiosity, for those of you who have been to one of our live workshops, one of our live events, or maybe you've been in, say, for instance, Barb's Bounces and Breakouts webcast, what might a trader be looking for as clear evidence of a reversal here off of, say, for instance, a bounce up from the 200 period moving average? What might a trader be looking for as evidence that price is turning back around and moving higher? I'll let you put that out there in the chat while we continue to talk about this. So that's the S&P 500. We're below kind of this diagonal trend line. We're below the 50 period moving average. The 50 and the 200 have been coming closer together. They've been coalescing in that range. We'll kind of zoom back out so that we can see the bigger picture here. They're not that far. I mean, realistically, they're not that close. Not as close as what we were looking at there. Okay, so Robin says moving above a midterm moving average, like the 50 period moving average. Yeah, absolutely. Close above the high of the low day. Absolutely. AJ says new high. Close above the high of the low day. Hold. Absolutely. Right? Close above the 200 period. All of those are great answers. All of those are answers that are designed to give us evidence that we're seeing a reversal, right? Rather than guessing whether or not we're seeing a reversal off of this 200 period moving average. For the moment, however, we could make two statements, I think, that are probably pretty clear. One, we've been testing that 200 period moving average. That 200 period moving average might be the definition in this case of uptrend versus downtrend, because a move below that 200 period moving average, we might consider this market to be in an intermediate term downtrend, right? That might be our definition or defining point, right? So at the moment, we could objectively say we are still in an uptrend long term, but the market is in a short term and intermediate term downtrend. Chris goes even a little further in his definition. Hammer, piercing line, bullish engulfing candle pattern. Yeah, all of those would be indications potentially of that bounce to the upside. So we're going to assume at the moment the SPX still bullish long term because it hasn't broken that 200 period moving average. But it's been a long time since we've seen the SPX down on the 200 period moving average. So the last time we saw it down even near the 200 period moving average was in August, right? The beginning of August. So, if we were to go back even a little bit further, let's take our time frame out here and let's go back 2 years on a daily chart. And the last time we were below the 200 period moving average was end of October into November of 2023. And so this has been a long, extended period of upward movement coming back down to that level, right? Yeah, absolutely, right? TS says, hey, zoom on out, right? Look at the forest and the trees. So we're still in an uptrend. So that kind of leads me now, right, into the idea that we're still bullish. Now, hang on to that. Put a pin in that thought for just a second, because I want to come back as we talk about our 14-7 strategy and work through some of the kind of thought process behind that. Now, let's take a look really quickly here at the NASDAQ. The NASDAQ yesterday pierced the 200 and became a little bit more bullish. And again, that might be because even though there were some algorithmic triggers at the 200 that stepped in for some buying, a move below and then back up probably added to the number of algorithmic triggers that happened that said, hey, price just moved below the 200 and now it's regained the 200. Buy. That might be one of the reasons why we saw a little bit stronger day in the NASDAQ yesterday, because it in fact moved through and then back up above the 200 period simple moving average. Now today, not so much. We're not seeing a lot of follow through here in the NASDAQ. In fact, it's sitting right back down a little bit more closely to that 200 period moving average, much like the SPX, but maybe a little bit more bearishly at this point. Oh, by the way, speaking of that, there is a feedback survey out there in the chat this morning. So do me a favor, if you wouldn't mind, fill out that feedback survey. Cameron is going to pop that up to the top and pin that to the top of the chat, which I appreciate him doing. This is also a good time for me to remind you to click on that subscribe button down at the bottom of the page if you haven't done so already. And join us over here on the Trader Talks webcast channel on YouTube. Great reminder, and it's a no-cost subscription to you. So if you haven't done that already, click on that and do that. And then sometime between now and the end of the webcast, click on that feedback survey and fill that out. And that helps us out to make these sessions better. So NASDAQ kind of a little bit more bearish initially, but also kind of right there at the 200 period moving average and not necessarily shifting to a bearish stance, intermediate term standpoint. Now let's think of the Russell 2000. And the Russell broke down through that 200 period moving average a couple of weeks ago, right? And has been continuing to move to the downside, although we're kind of at a horizontal support level here from a technical level back down into this 2000 to 2050 mark. And we saw kind of that hammer-like, although, look, here's the thing. Here's the thing in this particular consideration, right? This candle yesterday on the Russell 2000, this is kind of a spinning top. We kind of see equidistant highs and lows, and a very, very narrow body. And we're seeing, again, another kind of equilibrium-based spinning top here. I think the zoom kind of shifts that perspective, because this could almost be, you could almost argue that this is a little bit hammer-like. It's not hugely hammer-like, but it's kind of hammer-like. It's like, no, I'll tell you what it's like. Okay, it's like Cameron May wearing parachute pants and dancing to Don't Touch This by MC Hammer. That's how much this is kind of like a hammer candle yesterday and today here on the Russell 2000. So it's not hammer, but it's hammer adjacent. Let's put it that way. Okay, that's kind of the way to think about this. So there might be the potential for a turnaround. We've got the RSI pushing lots lower down into the lower reversal zone here. So there's that potential move to the upside. All right. Okay. So those are kind of our three primary indexes. I want to also take a look at the VIX really quick here. And we're going to pop back over here to the VIX grid. And we see that the VIX moving higher once again today. And that would be an indication, perhaps, that there is some expanding volatility, right? Yeah, Cameron and MC Hammer Pants, you got it. Take that mental image home with you today. All right, I'm giving you something for free right there. But take a look at where the VIX is. It's kind of at this high, in this range where it has kind of stalled a little bit in this range. They would have to be awfully tall hammer pants, because Cameron's got like a 48-inch inseam. I mean, he's like 7 feet tall, literally. 6'9", I guess, to be fair. But there you go. Look, the VIX kind of running into this range where it has stalled before, and we see it kind of giving back a little bit. So there's likely to be, unless something else happens, the market is quickly digesting kind of all of the influence that we've seen from tariffs and everything else. And that's what the market does. The market is a digestion mechanism, right? It digests that information and it spits it back out in price action. And so we see the volatility kind of coming off that high a little bit here. So that's where we are, right? High implied volatility, indexes at a support level. So let's now we're going to pivot really quickly here to our monitor tab, and we're going to take a look at our 14-7 strategies. Now, for those of you who are brand new, let me kind of outline the basics of this particular strategy. The idea is, when the SPX is bullish, we sell 14 days DTE, we sell a 14-day DTE vertical spread out around the 15 delta or one standard deviation, right? One standard deviation as expressed by the probability of expiring curve. And then we buy it back at 7 DTE. Okay. So we sell it at 14, we buy it back at 7. This is the most current iteration of this. Okay. And we sold this iteration. This is the 12 March expiration, 25, the 5810, 5800 short put spread. We brought in $1.90. So we're not bringing in a lot because it's full, it's far away from the at the money strike. It's going to be far, far out of the money. Here's one of the reasons why this fluctuates. Number one, right? And Asma asks a great question, is because as we get closer to expiration, Chris is 100% on top of this, right? Vega is changing, but there's also something else that's changing as we get closer to expiration, and that is gamma. Gamma is the option Greek that's going to put that kind of back and forth. You can notice as we're sitting here watch this number right here. That's the mark price for this particular spread. And as the market moves, as the SPX moves up and down, you can see that market change, the price of the market changing the price of this spread quickly. And in fact, it's bouncing. And I've watched it just as we've been sitting here. I've been watching this bounce back from being a mark price of about $2.50 to now a mark kind of sitting here right around the 565 range, 560, 565, bouncing up into the 60 range. And look, and now it's bounced up to $8, right? So there can be some volatility, especially when the market is moving simply because gamma increases as an influence the closer we get to expiration. So gamma becomes more significant the closer we are at expiration. Vega becomes less significant the closer we are at expiration. Theta, time decay, becomes more significant the closer we get to expiration, with the exception of a far out of the money or a far in the money option. Remember, we talked about the curve for a far out of the money option, if this is expiration here, right? We talked about this time decay curve looking somewhat like this, right? And the sensitivity as we get to that absolute number as a far out of the money or far in the money option changes like this, whereas the sensitivity of an at the money option goes the other direction. It increases as we get closer to expiration. So these are some of the things to keep in mind. This is the reasoning behind this particular strategy. So we kind of have to keep that in mind. We're playing to the probabilities, number one, and we're playing to the sensitivities of this strategy, number two, in this context. And number three, we're playing to the kind of the overall perspective of this strategy in terms of short-term movement. Now, a lot of people have asked the question, well, why don't we just hold on to this to expiration or through expiration, right? And the idea being that we don't want to hold this into expiration. Now, we could, theoretically, right? Because index options, especially European-style index options, don't have that risk of early assignment, okay? But we simply want to capitalize on this initial theta decay, right? This portion of the theta decay is what we're trying to gain in this particular strategy. Now, sometimes we're going to take losses. In this case, the market made a big move, and we know that that can happen, and I want to be aware of that fact. And I want to be, this is a good example, right, of the fact that, boy, even if we sell, this was a 15 delta vertical spread, right? Just again, here's a quick check. What's the probability of a 15 delta being in the money at expiration? Just curious if you kind of are keeping up with that as far as the Greeks. What is the probability of a 15 delta being in the money at expiration? About 15%. Well, guess what? This one right now, as we get into this time frame, look at where the SPX is. It's at 57.56. Look at where our short strike is. It's at 58.10. This is in the money, right? So 15% delta approximates about a 15% probability of being in the money at expiration, right? Buse and Greg, flip those over. Melissa, flip those over. 85% probability of being out of the money at expiration, right, is what the 15 delta imports. So this is very likely to be out of the money. But wow, the index made a big move. We know that. And we know that that's a potential risk. So here's what we're going to do. And to get to the point here, the question about managing this trade, we're simply taking it as it comes, right? So what we're going to do is we're going to put on an order to close this trade down, right? We're going to put on an order to close this trade down, and we're going to manage our way out of it. And that's kind of the process here, right? So we're going to right click, create a closing order. Now, because this is bouncing around so much, right, I'm going to see if we can get this for a limit price. I'll see if we can tag this and get this for a limit price of about $5.25. Now, $5.25 loss means we're wiping out a number of our winning gains. We understand that. That's the risk that we take in a strategy like this. That's the risk that you take in any strategy that involves selling premium. We're going to go ahead and we're going to click on confirm and send. We're going to read through this order, make sure that this is a closing order, make sure that we've got this in place here. Now, we don't put any management on this. We haven't put any management on this type of trade in terms of trying to take this off at a particular maximum gain. Look, we got it for 510. That's even better than 525. I'm not a math genius, but I know that 510 is better than 525 when it comes to buying something back. Okay, so we closed that trade down. Now we're out of the trade. So now let's go back to the chart here really quickly, and let's bring up our index options grid. I've shared this. This is in the description of the webcast so that you've got this as a shared link. Remember that anything that we share is simply for illustrative and educational purposes, is not guaranteed as to time or accuracy. I'm going to do this here really quickly just so that you guys that are here in the chat can have this as well. I'll go ahead and share this grid, but just remember that it is not guaranteed as to time or accuracy. It's out there in the grid. So here we are. Probability of expiring cone is an expression of one standard deviation movement. So we're going to go to the trade tab really quick, and we're going to say, all right, where's our 14 days to go until expiration? That's the 19 March expiration. So since the market currently still kind of right at the 200 period simple moving average. Now, Qual asked the question, what if I'd closed the trade yesterday? I could have. You're absolutely right. I probably would have taken a smaller loss, but it didn't fit the strategy. Sell it at 14, buy it back at 7, right? Sell it at 14, buy it back at 7. Now, we could put a closing order on that says, hey, if this has made 80% of its maximum theoretical gain, close it out automatically. We'll talk about that. But let's kind of get through this next iteration as we work through this trade. Now, here's the thing. Implied volatility is increased, so it's very likely that these premiums are a little bit juicy, which means that the width of this probability of expiring cone has widened as well, because that's driven by implied volatility. So we're going to go to the 19th of March, and we're going to look for the intersection of the 19th of March and that price right there. That's the intersection. That's one standard deviation. 1 sigma for those of you who are so quality control inclined. So our level there is right 54.98. So we could call that kind of roughly 55, right? 5,500 is that one standard deviation intersection, 14 days out. That's what's suggesting is a likely range of one standard deviation move for this index in the next 14 days, right? So there we are. Now, where would the price of this index have to be in order for these options to be in the money? It would have to be down here around 5,500 or less. Now, we know that this market can make a one standard deviation move because the last time we did this trade, it did. It made that move of one standard deviation. So that's not a guarantee that this isn't going to get hit. So let's go over to the trade tab. We know where our mark is. It's about 5,500. We're going to go to the trade tab, and we're going to open up the option chain for 14 days to go until expiration. That's the 19th of March. We're going to go over to the put side, and we're going to see which spread we're going to sell in this particular case. We know that it's about the 5,500 mark. So 5,500 is way down here. That's about the 18-cent delta. I'm okay with it being the 18-cent delta. It's also the intersection of that one standard deviation line. So what we're going to do is we're going to go a 10-point wide vertical spread. That would mean the 5,500, 5,490 is our 10-point wide. That's what we've been doing. So notice that those spreads are pretty tight, the bid-ask spreads. Okay, Alex or Alexis, why the put side? Because we're going to create this as a vertical spread. We're still expecting bullishness, right? Remember we said this is still above the 200 period moving average. So we're still expecting this isn't a long-term bullish trade. If it flipped below the 200, we'd be selling a call spread. But because it is still above the 200, we're selling a put spread in this case. Great question to ask. We're going to sell the 5,500 and we're going to buy the 54.90, creating this vertical spread. And we're going to bring in $1.40 for it or thereabouts, right? And now what we're going to do is we're going to put this trade on simply from that perspective. We're going to see if we can get it. Actually, we're going to see if we can get a little bit better than that. It's kind of bouncing back and forth. I want to get this at about $1.45 or $1.50 in this trade. Now, if we're getting that much credit, and we can kind of see that that's, again, gamma is getting this, right? As this moves around, we know that we've got a maximum loss. Now, the last one, we didn't take maximum loss. We closed it down before we got to the maximum loss. The way that we would achieve maximum loss in this particular case is if it were in the money and we were to hold it all the way through till expiration, both sides expire in the money, and it simply settles to that maximum theoretical loss. But we closed the trade down prior. Now, what we're going to do is we're going to put this in our index options weekly group, and we're going to see if we can get $1.60 for it. And we're going to click send, and we're going to fire that order off, and we'll see if we can get $1.60 for it. Okay. All right. So we'll kind of hold on to that and see. Now, if this, I just out of curiosity, right? So I kind of want to go through this. If this had gone down below that 200 period moving average, where would we be selling a call spread? To address Alexis's point here, so let's go to our 319 and let's go up here to our intersection at 319. That's right here. That's about the 60-20, we'll call it 60-20 crossover here. And that might be where we would sell a call spread, one standard deviation above, right? So let's go back to our trade tab. Whoops. Let's go back to our trade tab. And now we got to go, holy cow, we got to scroll. I got to go to 150 strikes out. So that's 75 up, 75 down from the at the money strike. And to get to the 60-20 strike, notice I'm still scrolling. There's the 60-20 strike. That's about the 11-cent delta in this particular case. So if we were to sell that call spread, the 60-20 by the 60-30, again, keeping it 10 points wide, right? On that side of the equation, we're bringing in $1.40 on this trade, right? Okay, so now we're holding on to that. I mean, we could sell this, and that would be kind of that other side of the coin. If we were to sell this one, that would be creating an iron condor, right? We'd be creating a, basically a one standard deviation wide iron condor. Now, to do that, we're kind of adding those two credits together, and we're reducing our overall risk. So if we were to create this as an overall kind of iron condor trade, our net total risk would go down in the trade. Our net total credit would go up because we're combining those two credits, and the risk is staying the same on either side, right? It's 10 points wide on either side. But looking at it from this particular perspective, again, I'm not ready to flip over to selling this, what is essentially a bearish call spread, because it's not moved below the 200 period simple moving average, right? So, Jerry, at some point, yeah, we could say, well, the market's soft or it's moving down, but it's still at or above. Now, we got $1.60 for it, right? So we brought in more than selling the call spread. But you know what? To be fair, we could do both. Let's do both. Okay. Let me do this. Let's do both. And I'm going to put this in a different location just so we can see. So this is going to be a separate trade from our 14.7, but we're going to manage it the same way just to see how this one would work. Okay. To see how this would work. So I'm going to go ahead and click on confirm and send. This one I'm going to put just in my index options group. So we're kind of doing the same thing, but the idea is, now, the one thing I want to do on this one first is kind of demonstrate how we might approach this, right? So let me come back and edit. So for our gain, our maximum theoretical gain on this trade is $1.35 or $1.40. What if we were to close this trade down if it's done the majority of the work that it can do for us, right? So what if we say, let's take this trade off if we can buy it back for 20 cents or less? So I'm going to right click. I'm actually going to change this to a first triggers sequential order. And then I'm going to right click and I'm going to create an opposite order. And I'm going to say, fine, with a good till canceled time in force, buy this spread back. Right? And I'm just going to use this to demonstrate how we would do this. Buy this spread back if we can buy it back for 20 cents or cheaper. And that way, if the trade does get to that point, right, where it's done the majority of the work, we take that trade off theoretically. Now, that's not a guarantee, right? It's not a guarantee that it's going to happen. It's not a guarantee that it's going to get there. We're going to put that on and keep that there as good till canceled. Our intent still is to manage this and take this off at 7 days. So next week, we're going to come back and talk about that. We're going to click on confirm and send. We're going to read through this order. We're going to put this in our index options group, and we're going to go ahead and fire that off, and we'll see if that fills. And it did. We got $1.30 for it, and now we've got an order already in place to take this off if it trades at 20 cents or less. So that's kind of the management of this particular trade and getting to that. All right. So now in this particular experience, one of the questions that somebody asked was, how do we know if an index is European style or American style, right? And so I want to kind of talk through this, right? So, and let me answer Shantha's question first of all. Do I need permission to trade SPX? It's grayed out in your trade tab. So you're not seeing, if you're just seeing this and you try to put on a trade on the SPX itself, right? So if you come over here and you click on the ask, it's going to say instrument SPX is not tradable. It's not a tradable instrument. The index itself, you can't buy and sell the index. But if you open up the option chain, then you should be able to see the options on this particular index. So I'm going to show you a couple things. We're going to go to the Market Watch tab here really quickly, and I'm going to go to our quotes subtab, and I'm going to go to the publicly available watch lists. Okay, publicly available watch lists. And the easiest way to find European style indexes is to come down here to the second group and select European style indexes, right? And now all of these all of these indexes that are displayed here, and you can scroll down through this list, and it's about 45 or 50 of them. All of these are European style indexes. They all track different things, right? Now here's the thing. We might pick one or another of these. Let's say we might pick, for instance, the DTX, the Dow Jones Transportation Average Index. We can go over here to the charts and we can see the DTX. It'll take a second for this data to come up. We can see that index itself. Let's take this one. Let's take the DUX. I think that'll come up, maybe. Or DRG, one of these. There's DRG. Okay. So there's the index itself, right? That's the index. But if we go over to the trade tab, you see that DRG has no options. So we have an index, it displays data, but it says, oh, now, man, there aren't any options available, even though it's a European style index, right? Now, there might be institutional and specific options that trade, which is why it's referred to as European style. But exchange tradable options are not available on this particular index. This is the New York Stock Exchange ARCA Pharmaceutical Drug Index, right? So how do we know that we've got a European style option or European style index that trades options? And that's where the scan tab comes into play. And in the scan tab, I've done a couple of things here. This is one easy way to do this, okay? So I'm starting. I don't have any filters on the scan tab. I'm just going to all indices. So that's the first thing I'm doing, scanning in category, all indices. So I'm looking at all indexes. And then I'm intersecting, so I'm drawing a Venn diagram with optionable indexes, right? So all indices, all optionable indices. Okay, so I've narrowed the filter, the list again. All indices, all optionable indices. And then what I'm taking out of the mix, What I'm excluding from the mix is this subset called American style indices. So what I've done is I've looked at all indices first, intersected with all optionable. So at this point, the filter is everything that is an index that is optionable, and then I'm taking out American style, which would then by default leave European style indexes. So if I run the scan here, now I get a list of indexes that are optionable because they fell in this category, and not American style because those were excluded out of this list. So these are all indexes that are optionable that are European style. Does that make sense? That's how we got down to this filter. There are 27 of them. Okay? That's how we get to that. Now, Jerry asked the question, most equity options are American style. Yes. There are very, very few equity options, some in the ETF space that are European style, but most of these are most equity options are American style. So here's what I'm going to do for you. We're going to come back up here to the top. I'm going to save this scan query as Euro style. Kind of like Cameron, Euro style. Euro style indexes, and I'm going to click on save. That's my scan, and I've taken all of those filters out. Now, you could filter this further if you wanted to, and then I'm going to save this as a watch list, and we'll call this Euro style indexes. Now we've got a watch list. You know what? I've got the same watch list. Okay, so we'll just put a different append on that. Okay, now we've got that watch list of those results, right? And now what I'm going to do for you is share with you that scan query. And remember that anything that we share simply for illustrative and educational examples, I'll put that in the description as well. It is not guaranteed as to time or accuracy, but that gives you an idea of how you can run that scan for yourself for European to find European style indexes, right? Okay. Showing is not tradable. Well, let's see. Let's do that again. Let's come back over here to SPX. Make sure that we're on SPX. And here was the one that we traded, right? So we went out here. We sold the 55 and bought the 54.90. And let's see, 55. We sold the 55. Let's see if we can do it again. Sell the 55, buy the 54.90. And it's right there, and that's trading, and I'm seeing active bid-ask prices. So that's interesting. Just make sure that you're not on the ETF. Now, the other thing that we could do is we could do the same thing with the XST, which is the mini index. We could go out to the 19 March, and the translation would be, this would be the 5,500, or the 550, excuse me, the 550 and the 549. So if we were to trade the smaller index, 550 and 540 is what we would be doing there. There we go. Now we're getting about the same credit, but take a look. Let's go confirm and send. Risk is about the same. Margin is going to be the same, or buying power impact is going to be the same. So the challenge would be, do you have more liquidity in the big index, or do you have more liquidity in the small index, right? This gives you maybe a little bit more granularity for creating the trade, but if we're going to keep it equidistant, 10 points, then you could do it in either the big index or you could do it in the small index and create the same type of trade. All right. So here's what we've done. Let's go back to our monitor tab and see what's going on here, right? So we got out of this one. This one's kind of sitting right where it was, although it's kind of working in our favor as maybe that index comes up. Let's take a look at our index options group here. And here's our SPX short call vertical that we sold. We sold it for $1.30. It's currently trading for about $1.30. So it's kind of sitting about where, oh, that one hasn't, no, we've got that stop order on it, that order to get, or limit order to get out. That's why we've got that order flag right there. So that's kind of sitting right about where it is. Let's go back to the chart again really quickly, and let's go back to our grid and just kind of review. Let's go back to our Your First Trade index grid, and you can see where the index is. It's sitting just up off of that 200 period simple moving average. Yeah, CB, I'm not terribly worried about it. These are liquid enough products that I've got a pretty good idea that there's going to be open interest, but something you can double check as well. Great question to ask, checking that open interest. Now, if you want to learn more about this strategy or index options, come on over to youtube.com/@TraderTalksWebcasts, and you can search for those topics if you want to learn a little bit more about Gamma, for instance. Type in Gamma, and look at that. There's Cameron May. There's me talking about Gamma. There's Brent Morris talking about Gamma, and so some great webcasts that you can use to follow up with learning a little bit more. Hey guys, if you haven't already, click on that subscribe button, and click on the like button as well. That helps to pop this information up to the top of the algorithm. And click on that feedback survey if you haven't. I appreciate that. My thanks to Cameron May for helping out. My thanks to our great production staff for keeping things rocking and rolling here on the technology side. Have a great week. I'll be in Scottsdale this weekend at the Technical Analysis and Option Strategies Workshop. If you're going to be there, come and say hi, and we'll see you again very soon. Take care, everybody. Bye-bye.